this is an interesting move here because we've kind of framed it as fast casual versus fast food. What is hot right now with consumers, given the fact that maybe some people have second thoughts about eating out, dining out because of inflationary concerns?
Sure. Good morning. Yes, so in the restaurant industry, it has been there's been some varied performance, as you mentioned. I think it's safe to say, broadly speaking, that restaurants are still fairly defensive. So while they do fall within consumer discretionary, they are on the very staple end. You definitely need to eat. You need to eat every day, and the consumer seems to prefer food away from home rather than food at home. But performance does vary widely because the consumer has not really slowed down or has not really shown a demonstration of slowing down in the short term. So we're seeing our higher growth names, as you mentioned, names like Shake Shack and Chipotle and others rallying materially, getting rewarded for their high growth, where our more traditional quick service restaurants have not yet gotten the love from investors.
So is it just about, though, that kind of fast food side of things? I mean, I think Chipotle, I think Shake Shack, they're more upscale, but they're certainly not like going to sit down for a meal, let's say, an Applebee's or a Chili's, or certainly not a Capitol Grill, that sort of thing. What exactly are the trends, and do the stocks accurately reflect what you're seeing in terms of consumption trends?
Sure. So what we do see in the restaurant industry is oftentimes the consumer will decide they still want to eat out. They don't necessarily have to spend as much as they might have formerly. So we often see a trade down across the group. So a casual dining consumer might decide to trade down to a fast casual experience. A fast casual consumer might trade down to quick service. And as long as the consumer still wants to eat out, it's historically quick service that proves the most resilient because they inherit a lot more from above than they necessarily lose from below. So that's where the fast casual players have really benefited, kind of being in the middle there, getting some trade down from casual dining. But again, because the consumer's holding up quite well, they haven't yet necessarily traded down to the same degree to quick service. And I think more importantly, investors have decided in the short term, if the consumer is still holding up pretty well, they'd rather go after some of the, the higher quality, maybe higher price, fast casual names that are higher growth, rather than the traditional, more value-oriented quick service names.
All right, so Jeff, if this is the case that you're laying out right now, there are assumptions you're making about what the coming quarters and years look like with regard to those consumption patterns. And then because of that macro backdrop, you make some top picks. What are those top picks, and what needs to stay in place in the economy for that to come to fruition?
Sure. Yes, so thus far, again, through the first half of the year, we have been pleasantly surprised with the resilience from a consumer perspective and their desire to eat out. And in that scenario, the names you mentioned, more the fast casual names like Chipotle and Shake Shack. We also cover Wingstop. They're performing quite well. So those fast casual names are holding up extremely well, up 40 to 80% year to date. But in our view, we do expect the consumer will slow in coming months as we look to the back half of the year. And in that scenario, we do expect investors will shift their preference to the more defensive, typically franchised quick service restaurants. The consumer will likely trade down, and investors will decide those are the more defensive plays based on both what they sell, which is value, and who sells it, which are franchisees. So in that scenario, a name like McDonald's, which is holding its own thus far this year from a stock performance perspective and putting up very strong fundamental performance, we view McDonald's as the most defensive within the quick service world. Not only are they heavily franchised and very value-oriented, but they're not as balance sheet levered as their peers. They own a fair amount of their own real estate, so it's very defensively positioned. So we think a name like McDonald's is well-positioned. Otherwise, we highlight Restaurant Brands, which is a portfolio company. They own Burger King and Tim Hortons and Popeyes, among others. For those looking for a broader portfolio, a little bit more growth, we think they're very well-positioned, especially with Burger King starting to show signs of stabilization and maybe a turnaround. So those would be a couple of names we'd highlight. We also are recommending Wendy's, which I know you mentioned earlier. So I think, the defensive nature of the quick service category, the franchise nature will lead investors to shift, especially if we see signs of consumer slowdown in the back half of the year, which is our expectation.